Welcome back to the Long Acres Finance channel. How does turning $50 per month into $1 million portfolio sound to you? It sounds pretty sweet if you ask me. That's exactly how investing $50 each month into the stock I am going to talk about today worked out during the last few decades. This ride to 1 million wasn't all pretty, but the final results for being patient and consistent were spectacular. So sit back, relax, and let me share with you the story of this great company. And at the end, we will talk about the future prospects for this business, and I'll tell you what I think about the stock today. The company I am talking about is none other than Texas Instruments. If you were a student at any time since the 1990s, it's highly likely that you owned one of their products. You know, the overpriced $100 TI 80-something graphing calculator that was required for math class, but also more commonly used to play Tetris, at least before smartphones came around. Back in the 1990s and early 2000s, Texas Instruments cornered the calculator market and essentially ran a monopoly business. Today, calculator sales account for just a fraction of the company's revenue, not even enough to warrant their own category on the income statement, as they are lumped into other revenues. The company has since shifted focus to semiconductors, with analog chips being the main driver of revenue. Before we dive in deeper, let's take a look at the stock's history and how investing $50 each month could have turned you into a millionaire. Looking back as far as Portfolio Visualizer allows, we can analyze the returns for Texas Instruments since April of 1985 through month-end February 2022. This is almost a 37-year period of time, which probably sounds like a lifetime for many of you. But think about it this way. If you were 20 years old in 1985, you would turn 57 years old this year. Parting with $50 once per month over the course of 37 years sounds like a small price to pay in exchange for $1 million. The exact time period is 36 years and 11 months, or a total of 443 months. 443 months multiplied by $50 per month is $22,150. Turning $22,150 into $1 million requires a multiple of 45. Multiplying your cash 45 times is absolutely amazing. And best of all, you could have done this on autopilot with Texas Instruments. Granted, it took nearly 4 decades to do so. But if you're young now, it's highly likely that you'll still need money a few decades down the road. Consistently investing in quality companies over very long periods of time can be a very rewarding system for generating wealth. Like I mentioned earlier, this journey with Texas Instruments wasn't all pretty. So let's take a closer look at the ups and downs of this path to $1 million. The first decade of this journey was rather slow and boring. Your money would grow slowly, but the value of your portfolio to remain quite small. It took nearly a decade for your portfolio to reach a market value of $10,000. This decade was filled with both good and bad years. In 1987, Texas Instruments returned a very strong 43.17%, only to follow this gain with 2 consecutive years of losses in 1988 and 1989, losing 25.26% and another 10.85% the year after. The early 1990s were a period of good times for the company. In 1992, the stock posted a 54.47% return, followed by a strong 37.68% gain in 1993. The double-digit returns continued for the remainder of the decade, growing in size as Texas Instruments profited from its thriving calculator business and the dot-com craze in the market. In 1998, your portfolio would nearly double as Texas Instruments shares grew 91.09%. 1999 was even better with a return of 126.32%. The small portfolio built on $50 monthly contributions that took nearly a decade to grow to $10,000 would now be worth about $304,000. That's a 30 times multiple in 6 years. Of course, today we know that the dot-com craze turned into a bubble and a pretty bad market crash for tech stocks. Being a shareholder of Texas Instruments during this time must not have been easy. The stock shed over 40% in 2001 and 2002, eroding most of the gains from the 90s. The portfolio value in our example declined by about 80%, all the way down to about $55,000. Then in 2003 we got a good bounce back, with nearly a 100% return, and the portfolio value climbing back over $100,000. Then a few more up and down years, with the portfolio peaking around $149,000 just before the financial crisis. While our investment is positive and the portfolio is slowly growing, we are still nowhere near the value we had in 1999. The next year and a half proves to be another rough period, as the portfolio declines to a low of $62,000 by March of 2009. Now it's been more than a decade since the portfolio first crossed over $60,000 in 1998, and it feels like the stock has gone nowhere. It's easy to look at Texas Instruments as a good investment from today's perspective. But picture yourself in the shoes of an investor in this example. How likely would it have been for you to keep investing in the stock during these turbulent times? Can you imagine a decade passing by and your portfolio value going nowhere? To make matters worse, in 2009, your position would be worth just 25% of what it was worth in 1999. Today, we know that the bull market following the financial crisis was very rewarding. Texas Instruments didn't shoot out of the gate like some other stocks did, but the returns since 2009 have been more than respectable. In May of 2016, the portfolio value finally exceeds the previous high from 1999. It took 17 years for this investment to break its prior record. This also includes 17 years of $50 monthly contributions. From then onwards, it was pretty much a nice ride up with a few bumps here and there. In 2017, the portfolio crosses past $500,000. In 2020, it briefly crosses above $700,000, before falling back to $500,000 during the pandemic. But since April of 2020, the stock catapulted all the way up to more than $1.1 million. 2022 started off a little rough for Texas Instruments, like many other stocks. But the market value of our portfolio still sits above $1 million at the end of February. The time-weighted rate of return for Texas Instruments since 1985 is 14.11%. That is a very good long-term rate of return. The $50 a month portfolio experienced a 29.9% compounded annual growth rate, so we took a stock returning 14% per year on average, and through compounding and consistent dollar cost averaging, we extrapolated this to return to nearly 30% compounded annual growth for our capital. This is the true power of reinvesting dividends and consistently contributing capital to your positions. During the course of this turbulent journey with Texas Instruments, the company kept one aspect consistent: its dividend payment. They did not stop paying dividends, not during the dot-com crash, and not during the financial crisis. The dividend income produced from this portfolio started out small, and it took many years for the snowball to pick up speed. During the first year, the portfolio generated $6.41 in dividend income. In year 8, the dividend income finally crossed above $100. In year 23, the dividend income crossed above $1,000. In year 24, the portfolio dividend income, for the very first time, exceeds your annual contribution by a few $100s. In year 33, the dividend income crossed above $10,000. In year 36, it crossed above $20,000. And in year 37, the portfolio generated $24,613 in dividend income. So in this 1 year alone, the portfolio paid you back more in dividend income than you had contributed to this portfolio since 1985. In fact, if the dividend income were to remain fixed from here on out, this portfolio would pay you 41 times your annual contribution each year. But I have a feeling that Texas Instruments will continue to increase its dividend in the future, and the results of this example will become exponentially better with each passing year. Pretty sweet results, but I bet most of you are more curious about the future prospects for Texas Instruments than its historical performance. Can this stock turn $50 per month into $1 million over the next 4 decades? That I do not know, but let's take a closer look at the company, and I'll tell you what I'm doing now. The stock has a 52-week high price of $202.26. Today it trades around $173, which is about 14% below the recent high. The current dividend yield hovers just shy of 2.7%. My last screener showed the historical 5-year dividend yield at 2.36%. Implying the stock may be potentially 12% undervalued today. I think this at the very least warrants a closer look into the business. Revenue has grown slowly but consistently over the past decade. The prior year saw a steep incline in growth, driven by demand and supply chain issues for the semiconductor industry. Texas Instruments is a highly profitable business with strong profit margins. Seeking Alpha ranks them as an A+ for profitability, based on strong margins compared to their sector and also the company's own trailing 5-year averages. Returns on equity, capital, and assets are also above average for Texas Instruments compared to sector medians. Strong profit margins are very beneficial to a business. It means there is more capital that can be deployed for R&D, used to expand the business, and shared with investors. Long-term debt has increased on the company's books from approximately $3 billion in 2016 to a little more than $7 billion last year. I don't think this is necessarily a bad position for Texas Instruments. Management deemed taking on additional debt at favorable interest rates to expand its embedded processing division as a smart bet. I would agree that this is a smart option to take. I believe the additional revenue and profit from these investments will outweigh the cost of servicing the debt and create value for shareholders in the future. Free cash flow has remained very steady during the past decade, and all the while investors received a consistently growing stream of dividends. Texas Instruments is a very safe dividend, with a payout ratio between 50 and 60%. The company has a long streak of strong dividend growth. Since 2011, the annual dividend growth rate has exceeded 10%. Dividend growth has trended down more recently, from the high 20% plus hikes we saw near the end of the last decade. I think we may see this growth rate cool off in the future and fall into the high single digits. Looking at the historical dividend yield, there have only been a handful of occasions where the stock traded with a dividend yield in excess of 3%. For the most part, the yield remained within the 2 to 3% range. Today's dividend yield is trending towards historical highs, and I think it makes the stock look attractive. Should market volatility continue longer this year and push the dividend yield close to 3%, investors will be presented with a rarely seen buying opportunity. Analysts are forecasting Texas Instruments to grow at about 8% next year, both top and bottom line growth. This assumption is supported by management expectations. Long-term earnings growth is projected at 10% per year over the next 5 years. If we bring this down to 7.5%, that's more in line with short-term assumptions and management's expectations. And tack on a 2.5% annual return from the potential current undervaluation, and add the 2.7% annual dividend yield. We come up with a 12.7% annual return assumption. To me, this is sufficiently high enough to warrant an investment. This assumption also doesn't factor in the compounding effect of dividends, so true returns stand to be better if Texas Instruments delivers on its forecast. I am currently buying up more shares of the stock in my personal portfolio. As of today, Texas Instruments is the largest position I own, making up about 2.6% of my entire portfolio. I will likely continue loading up on shares as long as the price remains deflated and the long-term return assumption stays above 12%. Let me know what you think of Texas Instruments in the comments below. If you enjoyed the video, please give it a like and subscribe to the channel for more content. Thank you for watching.